Welcome to episode 20. They say that 90% of podcasts don't make it past episode 3, then 90% of the survivors don't make it past episode 20. In other words, only about 1% of podcasts make it their 20th episode. It's cool to be among the survivors. I really appreciate the support from all our listeners and guests thus far. The guests have been tremendous, and I've loved all these fun, nerdy, insightful conversations. As you know by now, I'm always trying to pull contrarian or non-consensus takes out of our guests. It's not about clickbaits or headlines. It's unique and better ways to think about investing in and building startups. And in that spirit, I thought it'd be fun to do a supercut of my favorite contrarian takes on the show thus far. We've got takes here on AI, SF, deal flow, co-investors, network effects, emerging managers, portfolio construction, and more. We've got a bunch of voices here, including Niki Scevak from Blackbird Ventures, Martin Tobias from Incisive, Mark Cardamone from Forum, Nick Moran from Newstack, Matt Conwell from Rarebreed, Rajiv Bala from Clutch, Peter Walker from Carda, Eric Golden from Canopy, Colin Gardner from Yonder, Zach Coleas from eponymously titled Coleas Capital, Chris Duvos from Ahoy, and Jerry Newman from New Ventures. One last thing before we get rolling. If you're enjoying the show, please give it a 5-star rating on your favorite podcast platform. The more reviews we get, the bigger the audience. The bigger the audience, the more episodes we can do with bigger and bigger guests. I'd really appreciate it. Shameless, I know, but it's really helpful. So thank you. Thanks to all those who subscribed, who've rated, who listened to the show. And with that, let's get started.
If you look at the best of the best, Microsoft never needed to raise money. They did raise one venture round, but that felt like a guilt-tripped round where they were like, you need to have expertise on your board, versus like they didn't. They were super, super profitable from the beginning. Google again raised a Series A from Sequoia and Kleiner, but didn't touch the $25 million. And Google was pumping out cash from day one. And so again, like all of the best tend to be, these dream stories of successful from the beginning. There's no hero's journey. There's no like, oh my God, these existential moments, and it's really difficult, and we needed to pivot, and like a lot of the successes are just successes from the start. And so I think people also memorialize, difficulty, where actually, if you look at the world, and mostly success was success from the start. And of course, a lot of those founders will create the hero's journey, and will create the hero's journey of these crucible moments. But on the whole, comparing it to the experience of the companies that had all of these real difficulties, it seems like just a success from the beginning.
What you just have to do as an investor is to make sure you're getting in at the right price, and that the company's creating a fundamentally sound business. I don't think about exits. If you're thinking about exits, for example, I posted something on Twitter about this. If you have an exit slide as a founder in your pre-seed deck, that is a huge red flag. You should not be thinking about exits. You should be telling me how you're going to build an incredibly valuable business. The exits are going to take care of themselves. And, people that were investing based on certain exit multiples have always had a problem. I didn't invest in any of these B2B SaaS companies in seed that were raising at 100x revenue. Most of the guys who did that got crushed because public markets are 6x revenue. And the exit values of these things are going to change over time based on the public markets. And, whether you have public markets at all, or whether you have big companies that are doing M&A at all. And big M&A in the US has gotten cold water thrown on it by the government and stuff like that. So exits are always a problem. I don't, in pre-seed, think about exits. I think about, can you build something that customers will pay for, and can you raise money for the next round? And can you get to profit? I am thinking about how you get to cash flow break even or profitability much sooner. I want you to be close to cash flow break even into Series A. And I want to have a reasonable path to get there. Many in the bubble in 2020 and 2021, people were like, oh, you don't have to be profitable until the IPO. It's a very good thing for the overall startup ecosystem that people are expecting you to get to profitability sooner, because once you're cash flow break even, you don't have to worry about exits. You just have to run the business. And I think it's a benefit to the overall system that there is a more focus on being capital efficient at the co-investor signal. Because when they say so-and-so is investing, you got to say, okay, how much of their fund is it? Is there actually a partner on it? Is this a deal that they're really committed to? Or are they, trying to save one of their, potential losers or something like that? You got to dig a little deeper, and you got to do your own work. Venture is littered with these stories of YOLO people. I mean, look at Theranos, look at WeWork. Lots of smart people thought that other smart people were doing the diligence. Look at FTX. And it turns out the other smart people weren't doing the diligence. They were just following other people that they thought were smart. This is a common error in venture capital. I try not to fall for that. I do try to invest with other smart, committed people, but I have to validate, are they smart? Are they in fact committed?
You get a lot of questions from LPs around like, well, who are the co-investors in the round? And I find that you end up getting a lot of emerging managers who optimize for investing alongside brand name funds because they feel like that gives some amount of credibility to LPs and might be a good signal to help raise the next fund. And especially in a time now where like the time in between rounds is longer, I think emerging managers, including myself, like over optimize for that. And I think what I've changed my mind on is like, I actually don't want to be investing with the brand name funds in that first round that we're investing in, because I feel like usually when they're coming down to like the stage we're investing in, it's like a tracker check. It's a rounding error for them. They're not really paying attention. They're just waiting for the ones that like really hit an inflection point so they can put more money in. And what I care about, and you're not going to get the ownership you want or like the size check you want into the round, and they'll probably make the price higher than it should be because like they don't really care what the price is in that round. And so what I want to do is get into the companies before they get in. And then I care a little bit about like who follows on afterwards, but I no longer want to optimize for like trying to invest alongside a brand name fund. I think if we're investing alongside a brand name fund, we're probably too late. Like we should have found them first.
It's not an access game. And if you're chasing like everyone else in the Valley, you're going to continue to repeat this naive conventional wisdom that venture's an access game. And it's just not. It's all about selection. You've got to outpick everyone else to be top decile.
We do follow on, and we say we follow on to our top tier companies. But what I would say as an emerging manager and as a early stage manager, what follow on typically devolves into is first come, first serve of the companies that are performing the best in your portfolio at that time. Like even when you say we have a follow on strategy where we hold things in reserves, once you have a company that's in seed moving to Series A that's doing well, the first few ones that are doing that are going to be the ones you're going to do your follow-on to, because they're also the fastest movers. And your fastest movers are supposed to be an indication of success. That's not always true. And so it becomes really hard to have the discipline to be patient and say, even though this is one of our fastest moving and highest performing companies, I don't think that's going to be one of our biggest winners. And so we're not going to follow on, right? And so that's a much harder thing to do for emerging managers, and something that takes real discipline. And somewhere historically other funds have made the mistake of going from a fund one to a fund two, of saying, hey, we're really good at first checks, so we're really good at picking winners. Well, it's possible to be really good at first checks and really bad at second checks. And if you're good at first checks but bad at second checks, you're going to have an underperforming fund because your bigger checks are going to be the second ones. So that means the larger portion of your fund, of your capital, is tied up to the ones that are underperforming, right? So that's a problem.
We believe that if you keep your fund size small enough and you are disciplined on the type of deal that you're doing and your entry price, you can create incredible returns on couple hundred million dollar, sub-billion dollar exits. And we've seen that happen in Texas for the past 20 years. We do have the $1 billion exits, but some great funds have been, have amazing performance without ever seeing an exit over $1 billion.
I think there's two stories that are oddly both true and feel as though they're in conflict, but they're really not, which is one, venture as a asset class is becoming more distributed, especially if you look at the earliest stage. So the way we talk about it at Carta is it's never been easier to start up anywhere across the US. And even fundraise from institutional VCs in a seed or even a Series A round. Like that can happen in Silicon Valley, of course, but it can happen in Charlotte. It can happen in Dallas. It can happen in St. Louis. It's happening more places. So that is trend number one, 100% true. And then oddly, the second trend is Silicon Valley has actually never been more dominant in startups as a whole. So this idea that there would be some sort of distribution that takes away the prominence of Silicon Valley from the startup ecosystem, when you look across all the capital and the activity, like it just isn't happening. Silicon Valley, if you combine San Francisco and San Jose as the two metro areas, takes in just as much share as they used to in terms of total capital invested. If you're looking at the AI boom that is centered squarely in the city of San Francisco, something like 50% of every dollar invested into an AI company is invested into a San Francisco company. Both of these things are true across, geography and venture, which I think is fun for Twitter fights to say like the death of Silicon Valley or who's going to overtake SF. We're not seeing it happening.
Our style of venture capital is very hands-on. And so we believe that you need to be physically close to your companies in order to be able to really affect change and be helpful in your portfolio companies in the way that we want to. We've got portfolio companies in Austin, Dallas today, and in the past I've had, Houston, San Antonio, others. When a founder calls us up and says, "Hey, I've got this problem," if we can drive down to them and start whiteboarding out a solution, that is where we feel like we can add a ton of value. Secondarily, all these companies at this stage they need to hire executives, they need to hire middle management. And my partner and I have just been in the business or the venture capital business in Texas for so long that we have very deep networks in order to bring the right person into the right business at the right time, which is one of the highest leverage things that we believe you can do as a venture investor or board member.
If you build a company inside a company, everyone can always say, well, it only was successful because you were at a big company, right? Fidelity is one of the greatest distribution of financial products in the world. You would argue, well, that any product you launch should become the most successful thing. Now, history would tell you that the company's launched a lot of products and not everything was nearly as successful as what I built there. But it doesn't matter. The credit you're going to get is always going to be underwhelmed by that part. So that's one thing for people. And so that's just a shout out to all the people trying to build stuff in big companies. The second thing is, so people think it's a lot easier than it is. The second thing is the internal frictions of building in a big company are a lot harder than a founder on the outside would think of. And it's a trade-off because it's a traditional innovator's dilemma. If you're at a big successful company, it has, rightfully so, this isn't with judgment, it literally is how I've always thought that the company as like a human organism is going to reject risk taking because it's protecting its core functionality. So this is what, the most recent thing with the founder mode stuff is kind of, in my opinion, what it's getting at is that the founder can tear apart their company, can shred it, can change directions, can say, this is the direction I want to go. But over time, if you work at a really successful company, I love Fidelity. I think it's one of the most successful companies ever. It would be my dream. Like that is ideal. If you want to build a company in a sector, it should be studied, and it's hard to because it's private and people don't know about it, but it's amazing. And it's so amazing that it's a big risk to say, oh, let's go try to do something different. Let's do this. Let's do that. That's a hard thing.
Starting companies is hard. Starting fund is hard. The difference I would say is like fundraising for a fund is much harder than it is for a company. The surface area of investors that will invest is smaller than people that will invest in a company. That being said, operating a company and growing it is much harder than operating a fund. And there's just a lot of tooling and kind of commoditization of the actual like fund admin and things like that. There's a lot of support there. Not that investing and picking great companies is easy, but I would say that overall, after you've raised the money, the fund is an easier path. But the fundraising path is like no walk in the park. And so I would stress to anyone that's thinking about doing that. A lot of people are like, hey, I need to go talk to 100 founders before I come up with my fund idea. And I'm like, yeah, I mean, that's probably smart, but you probably need to go talk to 100, 200 LPs and get some relationships set up so that you're even ready to go fundraise, because it could probably take you years if you don't have that already set up. And I know some wise people have told me that fundraising is the easiest when you've made other people money already. I'd really stress for anyone thinking about becoming an emerging manager, have you made anyone any money? And if the answer is no, like maybe you'll be fine fundraising, but it's going to be a lot harder.
What's the biggest mistake you see marketplace founders make when they're trying to establish product market fit?
The big thing that I see a lot of people doing is spending a lot of time on product and like the actual product experience without proving out that they have something when it comes to supply and demand matching. That's like the number one thing for me, is that if you really don't have like a strong supply set that the demand is like seeking out, you're just not going to win, no matter how good your product is or anything like that. I just don't like, that's my big litmus test, is that there should be market pull. Like as soon as you start offering supply that is like really unique and essentially maybe underutilized or just not accessible, like typically, you're going to find that the demand is pulling you to bring more and more of those assets online. And if you don't have that, it doesn't matter what else you do. Like you can maybe band-aid it with like lots of demand, but I wouldn't say that that's going to end up being an amazing business, because you're essentially trying to push demand into a commodity supply set. And that can be really difficult to do unless you have some like unique advantage that other people don't have.
I tell founders when they think about platform risks, I'm like, look, think about it like it's the nicest beach you've ever been to. And there's all sorts of people there because it's the nicest beach you've ever been to. It's like, oh my God, this is amazing. So much business to be had here. But there's no buildings there. There's nothing there because the hurricanes come through on a regular basis. So what do you do in those instances? You build a shack that when the hurricane comes through, you don't mind if it gets wiped out. So when you build on top of Facebook, just make sure to take home the cash every day so that when the hurricane comes through, you got that cash at home. Like, don't build equity, don't build structure, don't build long-term durability on top of basically a beach that can be wiped out by a hurricane. Just build a cash business. It just generates cash. And that's fine. There's nothing wrong with that. You can build a great business doing that. Just don't assume that will be a sustainable long-term place, because it won't be, almost ever. There's no, like, if you think about platforms, the sort of Michael Porter business model strategy becomes so clear, which is that like their incentive is to take all of the existing players who sit between them and their customers and take their margins and drive those margins as small as possible, because every incremental dollar that you get, they don't get. And so they want to commoditize you. And so their PMs are literally looking at your products saying, ooh, what can we build ourselves quickly that does the same things these guys do, that we can integrate into our own platform and give away for free? Because all that margin will flow over to us, and then that margin will be sucked out of basically those service providers. I don't think you've seen any businesses that I can think of that have built really sustainably on top of these platforms. Services businesses, yes, but not technology businesses valued for the equity that they built. Every founder's got ideas. You go through the life, you experience the world, stuff annoys you. Like right before we started talking, I was having problems with my mic and my setup here, and I was like, oh, so annoyed. So I have ideas about how to fix them. Every founder has ideas. Your ideas are meaningless. Like what really matters is, do customers really want that? Do they desperately need what it is that you have? A lot of people don't ever go out and talk to their customers. And so validating the fact that the ideas that you have are valuable. What I like to say is, until you can cold call a customer, so you don't know them, at 9:00 at night on their cell phone while they're putting their kid to bed, and describe what you do in one sentence. And instead of them saying, fuck you, why are you calling me? They're like, ooh, I want that. You don't have anything. But when you get to that point, that's the magic of finding the very beginning of product market fit. That's when you have something that people actually want. When Travis and I first started Uber, he and I were at this party and told me the idea. And I was like, oh my God, I want that. Now, to prove how much of an idiot I am, like we proceeded to argue for the next 2 hours about whether or not he'd get to the taxi lobby. But like the value of the idea was so good. I was like, push a button, get a car. In San Francisco back then, it was just so painful. So that really is the most important thing, is like, whatever your idea is, go into market. And I like to tell people that like the cold LinkedIn message test is just like that cold calling test which is like, if you can send people cold LinkedIn messages and they respond to it, boom, you got something.
Every venture capitalist says they're contrarian, but if they're investing in AI right now, they're not a contrarian, obviously. I love one of the reasons, like with Trade Desk, where we had a hard time scratching together the first round for Jeff. I mean, nobody else believed it, So that ends up being a better investment, I think, than one where everybody believes it. I've seen investments where people are like, oh, we have a pool of investors. We have 80 people interested. We're doing uncapped notes, things where you're like, wait, why would I do this? There's absolutely no potential financial return here for me. The company, usually that's with somebody who's, a previous founder who's done very well. And I understand why people are excited about it. But if you can't make money, then, being part of a successful company doesn't mean much, right? Like as an investor. I guess that's how I feel about AI. I do have some reservations about the hype. The technology, I think, is amazing, right? I mean, the technology is crazy. It's, write me a Shakespearean sonnet on, interest rate changes, right? It's like, okay, it does, It reminds me of a line in iRobot where Will Smith says to the robot, he's like, oh yeah, well, can you write a symphony? Can you create a beautiful oil painting of the sunset? And the robot looks at him and says, can you? So I feel that way about this technology, right? Like it does things I can't do. I mean, I'm sure I could write a sonnet about interest rate changes. It would probably suck and it would take me like 3 days. So yeah, the technology is like magic. On the other hand, it's not and can't be human level intelligence. I mean, it doesn't do what humans do in thinking. And it can't evolve from what it's doing to what humans do. There's this great book that came out recently called The Origin of Intelligence. It came out, great book. It talks about the evolution of the evolutionary stages of becoming intelligent. When you get past the third stage, it's like, oh, okay, well, one of the things that humans do is they simulate their actions, their own actions, right? If I put my foot here, what's going to happen? And a lot of animals do this. And then the next stage is they simulate other people's actions. If I say this, what are they going to say, right? And this is a big part of our thinking. This is not what AI is doing, right? AI is doing maybe the first 3 stages. It's learning and repeating. It's not doing past that. So, well, I think the technology is amazing and magical. I don't think that it's going to replace humans in general purpose jobs, which is fine. I mean, I think, there's plenty of places to use the technology. A couple of the companies I've invested in are using it as a tool, makes part of what they're doing much easier. But what they're doing is not being an AI company. They're doing something else and using AI as a tool. So that's great. I also think that if you could have invested in one of the early AI tool companies like OpenAI, that also would have been a great investment, but that's already passed. So yeah, I'm not investing directly in AI companies. And most of what I see people saying they're going to use AI for doesn't seem that exciting to me. And then the ones that do seem exciting are, $50 million pre-monies for, 2 people and an idea. And that's, you can't make money doing that. Not on a portfolio basis.
I actually think that venture is too big for people to invest comprehensively. Let's put it that way. Now, there's riches in the niches, and I think this is kind of where I've most evolved in the last 10 years. So where I'm going with that is I just described platform funds. So historically, I've really loved these groups that invest in community, platform, infrastructure, whatever you call it. First round is my archetypal platonic ideal. And so for a long time, I looked to replicate funds like that because I thought the challenge of investing was so vast that you needed to be an intelligent switch at the center of this broadly distributed network so you could process the world and get to the right answer. And that was Data Collective in 2011 when we invested there was kind of that. They had this collective that kind of created great leverage for them. What that did is it kind of closed my eyes to I actively rejected the people who I thought were the lone sheriff who were going to round up the baddie on their own. There are a lot of groups where, it's a single GP. And that's all, very often, solo GPs are where this becomes most acute, or even teams, are, sometimes people play the game like tennis teams, not like basketball teams, right? Everybody's got their own match and they're just out there, they're doing their thing. And I thought that was inadequate to the challenge of investing. And I think I've been wrong on that. So now I think of people on a spectrum, and what I want to figure out is just, are they the best at what they do? Do they have a sustainable competitive advantage wherever they exist along that spectrum, rather than in the old days, I just said, I play in this third of the spectrum.
I think if you're betting on emerging managers and smaller funds, solo GPs are a great bet. most institutions, it felt like probably like 10 years and before, very rarely would do a solo GP fund, right? It was usually key man risk, right? Key person risk. And so they kind of addressed it as, right, like this key person, key man risk is too much. And I think there's been some reframing, largely from like solo GPs, in terms of like, no, we can like, we're more nimble, like we're faster. This is kind of what you're buying in a partnership anyway, is like a bunch of people come together and they're all kind of like independently operating, right? And then you have like this messaging from the established funds where it's like, yeah, the best deals were usually the most contentious, or like other partners around the investment committee table like didn't agree, right? And then like you end up saying like, no, but this is like market changing, right? Like it doesn't fit the mold, like it is different. And so I think like to me, bigger firms, like great bigger firms, are just a bunch of solo GPs that have like come together. And I think that is kind of maybe missed from like the institutional crowd.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.